Hey everyone, and welcome. Thank you for joining us for today's Meet the Analyst webinar, The Digital Shelf for CPG Brands, How to Win Market Share on Top Retail Media Networks. I'm your host, Jeremy Goldman, Director of the Marketing and Commerce Briefings at Insider Intelligence here in our New York City headquarters, and I'm joined by my colleague, Principal Analyst Andrew Lipsman in Chicago. Hey Andrew, great to have you as always.
Hey Jeremy, great to be with you.
And before we get into the main presentation today, I'd really like to thank ChannelAdvisor for making today's webinar possible and welcome Kevin Cohen, Brand Analytics Strategy Director at ChannelAdvisor. He is joining us from the south of France, so we're all a little bit jealous. Hey, Kevin.
Hey, Jeremy. Hey, everyone.
And a few things before we dive in. We have a ton of information to share, but there's no need to take notes. We're going to email you a link to view the slides and the full recording afterwards. But we do want you to participate. So just use the chat window on the right to submit some questions at any time during the presentation, and we're going to get to as many as we can during the Q&A. So with that, Andrew, I know you have a loaded agenda. You have a lot of good stuff. What's on the agenda today?
Thanks, Jeremy. So great to be with you, everyone. Let's dive right in. So before I get to our agenda, which I'll hit on in a moment, I just want to pause for a moment and sort of tell a quick story about Buy. You're probably familiar with this brand. You've seen it at this point. We tend to think of the digital shelf as this hyper-optimized, complex, data-driven environment. And it's very much that, and we'll talk about some of that today. But this is one of the earliest winners in CPG on the digital shelf. It was actually Amazon's Vendor of the Year in 2015. It became a category leader in different beverage-driven categories, overtaking the PepsiCos and Coca-Colas of the world in those categories. It ultimately rode that success to a $1.7 billion acquisition by Dr. Pepper Snapple Group in 2016. I think of Buy as something that was a better for you brand. This was during the vitamin water craze. And back then, vitamin water basically had, a high sugar, better for you beverage or a artificial sweetened beverage. But if people wanted a better for you beverage of this variety, there wasn't something that was also natural. So I always thought that was a big part of the success of Buy. And it was, right? There were people who might have been searching for better for you versions of these beverages. But it was much more than that. And I talked to the VP of eCommerce at the time, John Denny, who's now at Cabin Ventures. And he said, I'm a big believer in building brand from day one, building a multi-sensory story and richer articulation of who you are than can appear in a text ad. Anytime you can move beyond that, you're creating much bigger, longer-term impact. So I want everybody to think about that for a moment, that really the story of success on the digital shelf very much begins with the power of brands. That is the one thing that truly scales across an increasingly complex and rapid environment. So with that said, let's dive in. The agenda, first, I'm going to lay out some context on the rise of grocery e-commerce. That is where the digital shelf predominantly plays out. So we'll talk about that trend and where it's gone and where it's going. We'll talk about the flood of CPG digital ad spend, particularly into retail media networks. Then we'll talk about the highly competitive digital shelf environment and who's battling out for that. And then we'll get into some marketing applications and thinking through how do you employ digital shelf strategies for success. So the rise of grocery e-commerce, there was a lot of talk a couple of years ago of the permanent acceleration of e-commerce during the pandemic. You can see here in the top left corner that in 2020, there was this huge acceleration. And the thought was this would stay in perpetuity and that e-commerce was not looking back. Well, it didn't happen that way. We've actually seen over 2021 and 2022 that we've gone right back to the trend line that we expected e-commerce to grow at overall. In categories like apparel and consumer electronics, we've seen it come right back, and it's even a little bit below those expectations for e-commerce. But the one area where we have indeed seen permanent acceleration is in grocery, food and beverage. You can see that on the bottom right. Is where we have stayed above that trend line, and we expect it to continue growing at above average rate in the coming year. So it will continue to stay well above that trend line. So here is what grocery e-commerce has done since 2019. So I'll high level it for you. We were at about 70 billion in the US in 2019. This year we'll do about 140 billion. So it's doubled in a 3-year time span. Fast forward another 3 years, and you've got another $70 billion coming in. So we'll see the same amount of growth. Obviously, the growth rates on a higher base aren't quite as aggressive as we saw during the pandemic years, but it's the same pool of money that's coming into this space. So there's going to be a lot more consumer activity, and as I mentioned, above average growth rates continuing. If we look at the top 15 e-commerce retailers, I love a good scatter plot. So that's why I'm showing this to you. This is plotting the top 15 over the 3-year period from 2019 to 2022. And on the y-axis, we're looking at their 3-year growth rate. And then we're looking at the market share percentage point gain. And you can see kind of where everybody falls out. But what I've circled here is the ones who have performed the best on average, both showing really strong 3-year growth rates and showing the biggest gains in market share, with the exception of Carvana, which maybe is kind of unique in its own right. It's the grocery players. It's Target, Walmart, Amazon, Costco, Kroger. So this is where a lot of the specific growth on the biggest players in e-commerce has come from in recent years. We can't talk about grocery without talking about inflation. The latest numbers have come in. I think we're seeing about a 13% year-over-year increase in grocery inflation. This data from Numerator shows different channels of grocery. And you can kind of see that, Club has actually held the line. Inflation's only 10% in that channel. Other channels, seeing low teens. But e-commerce actually has seen the most inflation, that digital in red, year-over-year inflation rates of 20% plus. So, that could certainly impact people's willingness to shop for groceries going forward. Grocery penetration does continue to increase, nevertheless, and we expect it to continue to grow over the coming years. I'll walk you through the specifics here. So first off, grocery is in gray, and that is the overarching category. The other 3 are subcategories of grocery. So you can see this year in 2022, it will be 9.9% e-commerce penetration, so right around 10%, and we'll surpass that in the next couple of years. Something like pet actually has already migrated in a very significant way over to e-commerce, well over 30% penetration at this point. Health and personal care in the high teens, and then food and beverage a bit lower, around 5 and 6%. So that 10%, the digital shelf, grocery e-commerce, is really important. Russ Derringer, founder of Stratably, said that e-commerce, it's all about granularity. It's not just an endless digital aisle, it's endless digital aisles, plural, and each aisle is a keyword. So this is really how we kind of shop, is through search in digital. But I want us all to take a broader perspective here and understand that it's not just about that 10% of activity that might convert online. It also influences how we shop in the physical store aisle. So the digital shelf increasingly drives the other 90% of grocery sales. It is increasingly a shopping tool and not just a sales channel. So let's talk about CPGs and retail media. So CPG brands have really increased their investment in digital in the last couple of years. From 2019 to 2022, it's doubled from $18.5 billion to $37 billion. We expect that to continue increasing over the next couple of years. If you look at the growth rates, it's kind of interesting, though. The 2020, which was the kind of peak boom for e-commerce, those growth rates ticked up from about 15% to 25%. But they continued growing, peaking at around 39% in 2021. So there was a bit of a lag. Those dollars really came in with a fury and full force last year. Now they're starting to rationalize a bit, but we expect them to stay in those mid-teen growth rates. So still a lot of growth ahead. Why did those dollars flood in like they did in 2021? Competition. You had these aggregators like Thrasio and Aquaco, Perch, et cetera, buying up a bunch of Amazon brands and other digital sellers and putting them on marketing steroids, and really using venture money, kind of funding the growth into retail media. Well, the multinationals, the P&Gs of the world, the Coca-Colas of the world, they weren't going to take that line down. They are used to owning the digital shelf in the store. They wanted to own the digital shelf online as well. And so they funneled a ton of spend into digital at the same time. So it really ratcheted up the competition in a pronounced way, particularly last year. At the same time, we've seen the rise of retail media, which has been one of the hottest trends in digital, really in the marketing world overall. and it continues to surge. This year, we'll see it surpass $40 billion in spend. And almost like clockwork over the last several years, it's an incremental $10 billion in spend is going into retail media year in and year out. 20, 30, 40, 50, 60 billion by 2024. If you cast this out to 2025, it's probably going to surpass the linear TV advertising market. Think about that market. About by 2025, that's currently about a $65 to $70 billion market. So where is this future growth going to come from specifically? BCG and Google did a study about retail media, and they estimated there would be 74 billion in retail media ad spending growth by 2026. Where those budgets will come from is first, just organic growth in digital. So disproportionately, as new dollars come into digital, it will flow into retail media. But trade budgets, trade and shopper marketing, which is huge in store, obviously, that's the next biggest pool of spend expected to migrate into retail media. Then shift from other digital channels. Facebook is probably the biggest pool within that segment where dollars are maybe looking for elsewhere to go. And then traditional media, those TV dollars that I just mentioned are another big piece of what's to come.
And actually, Andrew, if I could, just ask one question about that one. I was kind of curious, are there any other, you mentioned Facebook, other winners or losers? Because I can see that shift from other digital channels, particularly given how hot retail media is, that there are inevitably going to be some players that are seeing a shift away, from their channels.
Yeah, well, I mean, Facebook is the biggest pool of ad spend that's being disrupted by iOS tracking changes. So the targeting and measurement has been disrupted. Facebook, Snap, Pinterest, even YouTube, all the other ones that kind of play more in the upper funnel space have certainly seen some of the bigger impacts. So I'd say those are the budgets that are looking to migrate. Google Search, another huge pool of spend, but because there's higher accountability, much like retail media has, those dollars aren't migrating quite in the same way that other channels are. And they own the first-party data, most importantly. So one other way to understand how retail media is going to be allocated over the next 12 to 24 months, marketers are saying that basically it's going to be fairly evenly split against performance marketing objectives, brand building objectives, and shopper or co-op marketing objectives. So that's no different within CPG in particular, a slighter higher percentage likely to come out of shopper and co-op marketing. It plays bigger in that category, so that makes sense. But it's coming from everywhere is the key point here. Let's talk about the battle for the digital shelf. So who are the big players basically taking market share in grocery e-commerce? So the names will probably ring familiar: Walmart, Amazon, Kroger, Albertsons, Instacart, Target. So who's at the top? So I'll take you back a little bit to 2019, actually pre-pandemic. Amazon was in the top spot. You can see a little bit ahead of Walmart, but Walmart really picked up a lot of steam, particularly due to the rise of click and collect and curbside pickup, which Walmart was ready for. They had really built out that capacity and did a great job executing during the pandemic. So they jumped ahead into that number one spot in 2020. You'll also see a huge increase from Instacart during that time, right? That was their moment of glory. And, they're right up there in the thick of things now with Amazon. I will caveat this by saying Instacart does fulfill orders for Walmart, Kroger, and some others. So there's a little bit of overlap in these market share numbers. But if you want to understand as a brand, how do you prioritize where those dollars are going? Those are the three at the top, and it's a pretty close race. Kroger around 10%, and then you've got Target and Albertsons in the about 3 to 5% range. So in the past, I've talked about retail media networks and really looked at like the different classifications that they fall under among the big ones. I hadn't done that exercise yet for grocery and CPG space. So this was my first cut at looking at who are the different types of networks that all of them might have slightly different characteristics. So the first segment really is the digital marketplaces. Amazon and Instacart is pretty much that market, and they really reign supreme there. Then you've got the mass merch and discount retailers like Costco, Walmart, Target, and Dollar Tree, another huge classification. The grocery pure plays, Kroger, Albertsons, Ahold. There's more that I just didn't have room for the logos here. Drugstore and pharmacy, Walgreens and CVS, huge. Maybe not so much for food brands, though they certainly sell a lot in these stores, but really for pharmacy brands. And then convenience. And this kind of runs the gamut between fast delivery. You've got Uber and DoorDash. You've got major convenience stores like 7-Eleven, then the instant delivery players like GoPuff. So there's 15 logos here. You're a CPG brand, a national brand. You're trying to sell through different channels. Like you look at these logos and you say, I've got to be playing ball with all of them. 15's a lot. Like I said, I left some fairly obvious ones even off of this chart. So it can get pretty unwieldy pretty fast when you think about it. All right, so within the context of the retail media market, Amazon dominates. They were the first to market. They really discovered the importance of ads in the context of e-commerce experiences. They're the most mature platform. They are winning by a lot. They've got about 3/4 of the market today. There's some up-and-comers, Walmart, Instacart, eBay in the space, but it's still a pretty significant lead for Amazon at the moment. Why is that? Well, we asked brands what they look for in a retail media network. And here you can see a stack ranking of the most important attributes. Right up at the top, the ones that have that are extremely important. It's traffic quality and traffic scale. Now, when we ran this survey, Amazon was number 1 for traffic scale by a pretty wide margin. Traffic quality, I believe it was number 2. So it was right up there on both of those attributes. But the third one that I also want to highlight here, because it's really important to the CPG category, I mentioned those offline sales, the other 90%. CPG brands really want that in-store omni-channel sales data, both for intelligence to understand how to reach the right audiences and what their shopping patterns are, but also to understand the full ROAS. The full picture of ROAS really depends on understanding that in-store piece. So I think that's a really critical takeaway. And by the way, it's something that Amazon doesn't have yet. They're working on it, but they're not there yet. It's an advantage for a Walmart or a Kroger, for example.
Andrew, it almost seems like, just to jump in again, that Amazon not quite looks at retail as a loss leader. Of course, it's like lower margin, but they're still trying to make money, of course, in that. But that they just see that as a deficiency, that they have to add that omni-channel data in order to not lose that market share that you were just referring to in the other slide.
Yeah, they are at a clear competitive disadvantage, and they need to get to a point of having a footprint. When you're talking about 3,000 and 4,000 stores for a Walmart or a Kroger, and Amazon is at, somewhere between 25 and 50 grocery stores. They need to at least get to several hundred before they have a data footprint that maybe starts to resemble these other stores. But really, they need to start talking about having thousands of stores. And that's going to take time, period.
Really interesting.
So in terms of what brands have as pain points or thinking about, how do they prioritize a retail media network? At the top of the list, the first two really go hand in hand. It's where's the ROAS? Where is the best performance, which obviously incorporates profitability. But because in CPG, it's such a low margin business that's really sort of a cost thing, much more than it is an effectiveness thing. So they want to see a reasonable cost of those CPM. So they really are price shoppers when they think about where should I allocate my ad spend. In terms of usability, I just want to point out self-serve is really, really critical. And that's something that I think a lot of networks have had to build out that capability if they want to better compete with Amazon. And then I also highlighted these other two lower down the list, omni-channel buying opportunities. So again, tying the online to offline, and access to audiences otherwise not reachable. Retailers have the potential to have in-store media experiences, and that's access to audiences that are otherwise not reachable on other channels. So that's another big advantage that Amazon does not have today. So as the space gets more competitive, we are seeing some of the next tier of players like Walmart and Instacart start to give Amazon more of a run for its money. Instacart. So there's an interesting little quick backstory here, which is Seth Dallaire, an executive who really helped build the Amazon ad business, then became chief revenue officer of Instacart, implemented a lot of that playbook there, got Instacart performing really well. You can see the return on ad spend is comparable to Amazon. Well, he recently went over to Walmart as chief revenue officer and implemented some of the playbook there, which is introducing a second price auction model, which gives brands more reason to invest. And also improve the search algorithm. And because of that, we've seen just overnight the return on ad spend take off for Walmart, actually surpassing both Amazon and Instacart, though it's a pretty close race at this point. All right, let's wrap up talking about the digital shelf strategies for success. So the way I talk to a lot of experts to say, like, what's most important in terms of winning the digital shelf? And they would say it's like asking me to choose my favorite child. Like, everything's important. You have to do it all. You have to do it all and do it well. But what I did discover is that there's a prioritization aspect of it, which is that you've really got to learn how to crawl, then walk, then run. And the crawl is you have to have the right foundation in place. And that begins with measurement, metrics, scorecarding. Basically understanding where you stand, how you're doing, and having the right KPIs in place so that you can monitor your own improvement and the competitive set. Some of the most popular KPIs I've already mentioned. So first off, this chart that we're looking here looks at brands and how they prioritize different KPIs depending on whether they're trying to grow market share or they're more focused on profitability. So there's some differences here. They both care about revenue growth, no surprise. But after that, return on ad spend and ACoS, or advertising cost of sale, which is basically ROAS kind of flipped on its head. It's effectively the same metric. That was the next top one for both. But for those who were focused on growing market share, so this is thinking more about brand building and long term, you might pay more of a premium to reach new customers or just to spend more on advertising now, but it can pay long-term dividends. So you see the difference in some of these KPIs that they emphasize. New to brand customer acquisition, right? You might lose on that actual transaction, but gain in the long run. Share voice is all about how do you make sure that your organic and paid impressions are seen and basically making sure that you're owning enough mind share in front of consumers when it matters. Inventory management. So we know that out of stocks are a huge issue. This helps show just how big of an issue it's been across different categories in CPG. Grocery basically still, as of mid-year, over 10% out of stock rates. Beauty, health, personal care, pet products, a bit lower, but still pretty elevated. Fortunately, a little bit down from 2021 when things were really bad. But if you don't have your product in stock, that's lost opportunity, one. Two, you can keep spending on advertising that ends up getting wasted because then you start driving traffic to where people can't even buy the product. It's a bad experience. It may even turn them away from your brand and towards a competitor. And then lastly, it really hurts your algorithms across all of these different retail media networks. So it takes time to fight your way back from that. Another key element is product creative. How the brand presents itself on the digital shelf. Does it stand out? Does it capture people's attention? As I mentioned, they were obsessively designed with how they stand out on the digital shelf. What I found out in my research was from Visit, who does visual AI for understanding digital shelf performance. And some of the best practices that they mention of things that can really work are high contrast imagery. So in this case, stark white background and really colorful pop in front of it works well in that environment. That may not work very well on the store shelf, where usually you want to have big, bold colors kind of blanketing the shelf. Simple text, buy, stands out very cleanly. Colorful fruit. They did some analysis of cough medicine that actually showed those that had grapes and cherries on their label on the digital shelf performed better than those that didn't. So those are the elements that actually can really affect consumer choice. Product content. This is where a lot of the detail in blocking and tackling goes into the digital shelf management. So some best practices: refreshing content more regularly. What we hear is that a lot of CPG brands will do it once a year or maybe on a couple of occasions, but they really need to be refreshing quarterly, aligning with seasonality, and also just trending search terms, which can change quite a bit over time. It's all about that search box, really. Product descriptions, you can see here for high key, these are keto-friendly cookies. Think about what a consumer searches for. It might be keto-friendly cookie or keto-friendly treat, whatever the case may be. You want to make sure you have those terms in the product description so you're capturing that search. Ratings and reviews, you have to meet a threshold of at least 4.2 or higher, have enough reviews that people have confidence in it. And then also make sure that you have enough A+ content, at least 5 images and at least 1 video to help really tell a more complete brand story. So product content is really critical here. Lastly, going into offense, I would say ad optimization is where it's at. So this is where I think the really strong brands will really separate themselves. And it's not just about performance, right? So much of this market is about search, and that is absolutely critical. But search drives a very specific behavior. And this is where dollars are flowing and where it's most competitive. So it's harder and harder to squeeze out some additional return on ad spend. You have to be really, really good at executing on search keyword strategies. But there are other units. There are sponsored brand and video units. There are streaming TV units that you can buy. And they all work differently. They drive branding and performance. And so this looks at Amazon ads and how they actually drive conversion. So sponsored product, the search ads, not surprisingly, about 3/4 of them convert within 2 hours time. That makes sense. It's very immediate. On the demand side platform, the DSP, this is upper funnel display and video ads. It's about 50-50 in terms of those ads converting within 3 days or after 3 days, after 1 day. And then OTT or streaming video ads, about 3/4 of those ads actually convert outside of 3 days. So a much longer term sort of impact in how that's felt. And then one last piece I'll say here is it's also about how these things work together, not just putting into upper funnel or lower funnel ads, but how do they have a synergy? That's where brands can really, I think, get some of that much better than average performance, finding the right mix. All right, so I'm going to wrap it up with the key takeaways here. So the first is that the digital shelf is 10% today of a $1.4 trillion category. It's growing quickly, will continue to do so, but it also drives that other 90%. That's a $1.3 trillion opportunity in the US. So don't lose sight of the big picture here. 2, it's important to think about the different retail media networks and prioritize them according to what your specific marketing objective is. Don't just look at ROAS and who's driving the best ROAS. That's a very blunt instrument. It's useful. I'm not saying don't look at it. It's an important KPI, but take a bigger picture view and make sure that you're aligning with what you're trying to actually accomplish, whether that's growing market share or profitability. CPGs need to start by getting the basics right. So that's really about the basic blocking and tackling on keeping products in stock and product content, keeping that refreshed, et cetera. And lastly, just to reemphasize, it really still is about the power of the brand. The brand has to matter, has to resonate with consumers on the shelf. You have to have creative that resonates with them and uses some of the best practices so that it pops on the digital shelf and can scale across multiple digital shelves. That's ultimately critical to how brands will perform on the digital shelf. And with that, I'm going to send it back to you, Jeremy.
That was really great. Honestly, Andrew, a perfect mix of data and actionable insights. So thanks so much. And before we get to your questions live, we've had some good ones so far, but keep them coming. I'd love to bring in our special guest from ChannelAdvisor, Kevin Cohen, Brand Analytics Strategy Director. Welcome again, Kevin.
Welcome, Jeremy. Thank you.
So I wanted to ask you, Andrew's recent digital shelf report mentioned scorecarding a bit. What's your opinion on scorecarding?
Well, our role at ChannelAdvisor is to help our customers improve their e-retail execution. And you can only improve what you measure, right? So scorecarding is a good way to basically take a snapshot of your performance and start measuring regularly. And on top of that, scorecards help you know why there is or there isn't performance, where to focus, which retailers, which area, know you are improving, compare retailers between them, and then prioritize your efforts. In the end, I think that scorecarding is paramount, but you quickly want to deep dive, to dig into the details, because, well, the final objective is to actually set goals to your teams internally, fix all of the issues that you may have online so you can, well, monitor progress.
And in your experience, what are the essential metrics to track and improve, for brands that want to gain an edge on their competition?
I actually have a visual for this. Could you perhaps display it? When we build scorecards with customers, we usually track between 8 to 16 metrics. And we group them in 4 pillars. The first one is assortment and availability. Am I selling the right products at the right online retailers? Are they in stock? Andrew talked about, out of stock issues earlier. Second pillar, price and promotions. Are my products sold at the right price? Are my planned promotion respective? What about, my competition pricing? Third one, share of search. Can customers actually find my products when looking for category or branded keywords? What about the competition on the search page? And the fourth pillar, content and reviews. We just talked about it. As a brand, you want to maximize your product detail page content, make sure it meets also internal policy, and show some social proof, thanks to ratings and reviews. So at the end of the day, of course, adjustments are possible depending on the industry and the retailers. But these four pillars are basically ChannelAdvisor's recipe for e-retail success.
So, and you mentioned adjustments. So I'm thinking, how frequently should brands audit these KPIs once they've set it? Surely you can't set it and forget it, right?
Yeah, of course. Yeah, that would be something you want to avoid, absolutely. So when it comes to the frequency, it really depends. I think when it comes to scorecards, I think monthly to quarterly scorecards are enough. However, in order to action it, which is the most important thing, you need way higher frequency. Let me give you an example. Out of stock issue. In that case, every hour counts. Okay. When it comes to pricing issues, enforcing MAP policy in the US, for instance, select customers of ours, notably in the CPG or consumer electronics industry, ask us to get their prices, to do more price monitoring each hour, so 20, 30 times per day. Then for product detail page content, so our fourth pillar, most of the time you want to audit that data, let's say weekly.
Okay, and let's say that I'm a large brand and I'm selling mainly through retailers, and I'm not that agile with e-commerce. What are some of the first steps to addressing that gap?
I think I would tell you to start small, perhaps with a subset of retailers and products, and then based on your e-commerce strategy, you want to define the relevant metrics to measure across the four pillars that we discussed earlier. Start measuring, you get a first scorecard, then take actions using any tool provided by any digital shelf monitoring platform. So you will have web app, email notifications, reports. And when you have that three phases, you want to create a virtuous cycle and iterate. Okay. In order to take actions, and that's obviously the most important thing, you also want your team to be properly onboarded, trained, and that is crucial. So here you may want to start with one country, show value quickly with the team. Most of the time, e-commerce, sales, marketing, data science team will benefit from that data. And finally, internally, you can have someone who will be basically in charge and create, the right reports, the scorecards, the notification for the members internally, so that you can create that value to the team members very quickly.
That was a lot of great information in a short time period. So thanks, Kevin. And now it's time to get into our audience Q&A. We've received a lot of really great questions. Keep them coming. One thing that we got that I wanted to just ask very quickly at the top, I think this is a good one. As our brand continues to ramp up e-commerce ad spend, we're looking to diversify our ad formats and channels. Do you have any guidance on where those next dollars are best spent?
Andrew, for you?
Yeah, well, I mean, I think it's probably a pretty common question right now, because I think that the moment that we're at is that depending on the brand, that money has funneled into Amazon and then maybe the next couple of networks, and then what's next after that. But it's gonna vary by brand and by objective. So I'll say figure those things out first. That said, I mean, I'm looking at Walmart right now and seeing that they've made some real interesting improvements to platforms. So I think the return on ad spend is there. I also think the ability to influence in-store sales is very high at Walmart. So I would think very strongly is that as an opportunity. Broadly speaking, and then Kroger is another one. I think a lot of similar capabilities, and they're very advanced when it comes to data as well, and have a pretty good feedback loop in terms of in-store sales. So all of that. So I'd think about those channels. Ad formats, move up the funnel. And I can say this because I'm not actually spending the money, but I think streaming TV is a big opportunity. I know there's a premium price associated with that, and that brands don't always love to invest as heavily. But I do think that that's a big opportunity. And in general, I think with digital, it's good to be early on a big new opportunity, figure it out and figure out how to optimize. So if you have some experimental budget or extra budget to spend, look at that channel and figure it out now, because I think you're going to really benefit in the long run.
It's a really good point there. I think this next one might be great for Kevin, actually. You mentioned quite a few metrics. And again, this is somebody concerned about how do you do everything? If my team has limited resources, do you recommend starting with just a few metrics and expanding later? And if so, what are the most important things if you have to start really small?
So, well, no, I wouldn't recommend to start with just a few metrics. I think it's better to start with a smaller scope in terms of products, retailers, but try to build a full version of the scorecards with, the 4 pillars that we discussed earlier. If you ignore some metrics, you may sometimes fail to understand why performance is dropping. In the end, metrics can, influence each other. So for instance, if you were to improve your PDP content, starting with title, pictures, rich content, we talked about it, it will mechanically improve your search results and in your share of search. Another example, identifying regular out-of-stock situations, then working with your buyer at the online retailer to fix that will also increase your share of search. And eventually, that will be better conversion and more sales. So I think it's better to start small and make sure you monitor the 4 pillars, everything basically.
That's good. This is another interesting one. I noticed this too, also, Andrew. Where did the score of 4.2 or higher come from when you spoke about ratings and reviews? I think we had actually more than one person who was curious about that.
Experts. I spoke to a lot of experts, and so that was basically it needs to be a bit above 4. I think you start getting way into the thinking of the consumer, but my sense is that that's kind of the water level at which kind of passes a threshold that, okay, this is going to be acceptable quality. And then I think they look at the volume of reviews to say, okay, is that number valid? Is it too thin, or is it something that can be affected by fake reviews or things of that nature? Obviously, when you start to see thousands of reviews, it becomes much more robust, and it's just all about increasing trust. That before they make that decision, they want to feel like they're going to get what they expect and that it's going to be of the right quality.
I think it is really interesting. It's on a 5-point scale, but 4.2 and below specific. Is not acceptable anymore. This might be good for Kevin. Somebody says, I've read that many CPG purchases happen without even a visit to the product page, like when a consumer adds to the basket in one tap. Knowing that, are product descriptions, reviews, and additional information as important as they might have been in years past?
Yeah, that's true. CPG purchases sometimes have close to zero consideration phase. But people check product info while in store, starting with the reviews, just talked about it, starting about content. So eventually, more content and reviews help with showing up in the search results. And so, that's obviously an opportunity that you want to seize.
That's good. Another question. I think this is interesting because this is tied to the news cycle it could be for Andrew or for either of you. Looks like Instacart will finally go public soon after a long wait. Do you think that will entail major changes to the platform and its capabilities?
Yeah, I mean, the way that I'm thinking about it, so I was just at grocery shop last week and they were really talking about their connected stores initiative. So broadly speaking, Instacart is now building out this whole platform of, I would call them digital services to enable grocers. And particularly if you think about maybe the small and medium-sized grocers who may not have the ability to develop this up themselves. They want out-of-the-box solutions. But I think all of that really is in service of primarily the ad business. It really kind of is about it's bringing digital capability, obviously serving the consumer and making a better experience for them, but it's also producing data. And that data provides the foundation for the advertising business. So I think that's really what Instacart is building. I think as they go public, they will be treated as an advertising company more than a e-commerce company in that sense. And because that's where the margins are going to be. So I think that's kind of the way to think about it. And yeah, I can't wait to see when they finally go public here.
Should be really interesting. This is I think that this could be for anybody also. Do you see any of these retail media networks offering traditional CPG measures that traditional marketers are looking for, like incrementality, anytime soon?
Kevin, I don't know if you have thoughts on this. I will say the word incrementality, I love hearing this. I've been in ads research for a long time, and right, that's the way to do it. It's not just does a sale happen after an exposure, because that ad can then take credit for that sale, even if it had no impact or minimal impact. Incrementality is what happens above and beyond what would have otherwise happened. This is critically important, especially in CPG, where if you can get an incremental lift of just a couple of percentage points, 2-3 percentage points, I mean, that could represent tens of millions, hundreds of millions of dollars for national brands. So I would like to see more of that. I don't think that it is systemic on retail media networks. I will say I've heard very good things about those who are using advanced analytics tools like Amazon Marketing Cloud to be able to, it takes some more work, but to be able to get answers to some of those questions on things like incrementality.
Okay, and we have, I think, let's do one more, and I'll get a take from each of you. I'm going to kind of merge one or two questions here. What within this broader space that we've been talking about today are you most excited about to watch over the next year or two? Is it, let's say, Walmart's increased ROAS over the recent term? Is it CPG brands looking at Amazon and not being as interested in them, let's say, potentially given the minimal footprint at brick and mortar? Is it something else within the measurement world? Maybe each of you guys can give a thought on that.
On my end, I would say, well, I'm working with CPG brands, consumer electronics brands on a daily basis, and I've been doing that for 6 or 7 years now. And I realized that I see brands with a very strong brick and mortar experience, and they are now, they are fully aware of all of the challenges they have in front of us. They are hiring the right people. They are looking for the right tools. And they're willing to learn and spend lots in the e-retail world. So it's kind of, crazy what's happening these days. And it wasn't the case 2 or 3 years ago. So it's very exciting.
Yeah, there's never been a more dynamic time in the CPG and grocery space that I can remember. I would say the big theme for me that I'm excited about, and I think it will play out in a big way in the next couple of years, is the growing role of the physical store in retail media. And that's two things in particular. I mentioned offline sales data. Let me paint a little bit clearer picture of how I think it could change things. If we saw some ROAS numbers that said, $4. So if you're putting in $1, you're getting $4 out. Well, you're not even measuring or incorporating the offline sales impact. And as we mentioned, that's 90% versus 10%. So even if it's a more subtle impact, maybe your $4 ROAS goes up to $8 or $10. How do you think that's going to change the way that you think about your investments in digital? I mean, that can create huge budget shifts. So that's one. The other one is the rise of in-store retail media. We haven't really thought about the physical store as a media channel, but you can reach people in the store with brand messages and drive either performance or just general branding effects. That's in the early days of starting. So maybe a little bit of a longer term trend, but both of those are ones I'm really excited about.
And I know, Andrew, you've gotten some really good information on the digitization of the in-store experience that's on our platform now, I believe. So thank you so much for that. And unfortunately, that is all the time we have for today. But thanks again to Andrew for joining us, and a very special thanks to Kevin and to the team at ChannelAdvisor. Our eMarketer production crew behind the scenes also deserves a huge thank you for making this webinar possible. They do amazing work. It's not even funny how great of a job they do. And as promised, we're going to be emailing you soon a link to the slides and a full recording. But before we wrap up, let me take a moment to tell you what's happening across eMarketer's media channels. You can register for upcoming live Analyst and Tech Talk webinars at eMarketer.com/webinars. And on the audio side, don't forget to tune into Behind the Numbers, eMarketer's daily podcast, everywhere you listen to podcasts. Andrew every now and then makes an appearance. And finally, please make sure to check out our newsletters. Thanks again for joining us, and enjoy the rest of your day.